What is multifamily syndication? Group of people in commercial real estate, and there's an investor or an operator or syndicator. And an investor may find a great deal but lack the capital to make it happen. On the other side, many passive investors, they want a return on their investments, but they lack the time or expertise even to execute a real estate deal. So that's how real estate syndication was born. The idea, the model, the business model of someone being a syndicator and working together with someone that has the money and doesn't have the time to execute deals. So syndicators identify, analyze, and negotiate great deals. There are a lot of great deals out there. There are a lot of bad deals out there. So it's the work of the syndicator to identify the great deal. And the syndicators are also known as the sponsors. They find the deal, they underwrite the deal. As part of the underwriting process is the syndicator identifies there's a gap. That is the difference between the cash required and the cash that the syndicator plans on personally contributing to the deal. So it's a structure. There's a legal structure behind syndications. I've had this question pop up in my conversations with investors in the past, like, so what do you do? I can assure you guys, it's definitely not this. We do not take the money and go party with the money. It doesn't happen. And essentially what we do is we find and underwrite the deal. We spend a lot of our time looking for analyzing potential deals and finding deals that likely include reviewing, okay, what's going to be the return on this deal if we put this deal under contract. And there are different ways that we look for the deals. It could be on the market, right? We could find the deals on the market, or due to extensive relationships that we have built with brokers. Some brokers will bring deals to us so that we can analyze and see, okay, what are the returns going to look like before they go on the market. Money is the name of the game, but due to good relationship, we at Westworth Capital, we also get to take a look at some really great deals and try to put them on the contract before I actually go on the market. So some deals would never actually see the light of the market. We snap those up as soon as we can. As a syndicator, one of the jobs that we do is the pre-acquisition due diligence. So after we put the property under contract, then we go into the due diligence phase. And once we can confirm that the numbers of the deal make sense, conceptually, the goal is to identify problems. So you want to see, okay, what's the surprise here? Is there anything that was in the original offering memorandum prepared by the broker that we've come to find out? So that might be a basis for going back, negotiating the price of the deal. So once that is done, then we begin to raise equity funds from equity investors. Ideally, you want to work with a syndicator that has his own skin in the game, that has money in the deal. If I have my money in the deal, I will take care of the deal. I will work hard for the deal to be successful. One thing to ask a syndicator when you are investing in a deal, do you have your own money in the deal? How much of your money goes in the deal? And then we go on to secure the debt financing. This is by obtaining loans from financial institutions, from the banks, the credit unions. We complete the acquisition for the syndication. And now that's when the real work starts. Even when there's a property management company handling the day-to-day operation, the syndicator still maintains the ultimate responsibility for the property's performance, for better or worse. If the property goes down south, it's never going to be the property management fault because we hire the property management company. So everything still comes back to the operator. Our investors hear from us through email all the time, right? Just last week, one of our properties in Dallas, we were just discussing after the asset management meeting. That property is actually outperforming what we had projected. We hadn't even gone halfway through our post-renovation revenues, and we're already beating it. What are the benefits? What are the benefits of investing in multifamily real estate syndication? Well, number one is the stability. Multifamily properties provide consistent valuations and consistent demand. 100 units apartment building doesn't experience a dramatic dip in revenue when one tenant or even two move out. So you have a 100-unit building, one tenant moves out, two tenants move out, or even three tenants. There's the stability in the revenue, and that is as against a single-family home or even a fourplex, right? Fourplex, one person moves out, that's already 75% occupancy. You're not even going to get an agency debt with that, talking multifamily-wise, right? Unlike stocks, gold, or Bitcoin, people need a place to live. So multifamily actually provides a basic necessity of man, right? Meaning they're always in demand. If you like to be in business for a long time, focus on two things. And those are the two basic needs of the humanity. Number one is the food, and number two is housing. So if you can provide any of that and you do it well, you're going to be in business for a long time. I like to be in business for a long time. And that's why I've chosen multifamily. Number two is the control. When market fluctuations happen, we have the ability to make operational changes, immediately reduce our expenses and limit the vacancies and ensure that our assets continue to perform. If there is a recession, lack of jobs, we can immediately make operational changes. Hey, if we were providing internet before, we will no longer be providing internet. Or if the clubhouse is open every weekend, before, now the clubhouse will only be open for a certain number of hours, because opening the clubhouse will mean utility bills, right? And also water. And so those operational changes will ensure that expenses are reduced and vacancies are limited. We can also offer concessions so that we can retain our tenants. Number three is the cash flow. The cash flow is the profit remaining after expenses have been deducted from the top line revenue. So think of gross rental income. So this profit is available to return to the investors as the cash flow. So we get this money from the gross rent and we pay all our bills, we pay the debt service, and there's money left. If you work with an experienced syndicator, we'll make sure that due to conservative underwriting, there's always money left. So that money is available to be distributed back to the investors quarterly or monthly. We like to do it quarterly at Westworth Capital. Also provides high risk adjusted returns. So the risk adjusted returns that we talk about here is the fact that while real estate and stocks provide the same returns, that's around 7%, 6.57%, depending on the economy, you will discover that housing returns are significantly more stable, even in the face of market volatility. Anything can happen tomorrow and Wall Street can decide something can change, and then there's a market volatility, and then the value of your stocks can go down, it can go up. But in multifamily, we're able to predict due to our conservative operations. Federal Reserve Bank of San Francisco, it's got the risk profile of government bonds. However, it produces similar returns as stocks. And the fifth is tax advantages. One of these tax breaks is realized through the magic of depreciation. Think about it. The depreciation is the theoretical loss of value the building experiences over the lifetime of the building. The land does not depreciate, but the improvements on the land, the government allows us to depreciate that. This depreciation is taken as a write-off, right? So the reality is that real estate is actually appreciating, but on paper, we get depreciation. So we get a double advantage of an asset that is appreciating and one that is also depreciating on paper. And that's the magic of real estate, and that's why we love it. What are the characteristics of a successful multifamily syndicator? Number one is relationship. Now that's this. They must be good with relationship building. It's important because it's a relationship-based business. And savvy investors will review a deal, and prior to actually contributing their own hard-earned money, the syndicator, due to the relationship building, can actually get better deals, right, from reviewing a particular deal. There are many times that we talk to brokers and talking about a particular deal, and the broker will go, you know what? I think I have a deal that might work for you. I think I have a deal that you might like. So through relationship building, you actually get deals that you never expect that can happen. Another thing that you want to look for is the financial analysis skills. You have to be able to conservatively underwrite and project conservatively. You don't want an aggressive syndicator. As operators, there are a few things that we pay attention to. One of them is the net operating income. The other is the cap rates. The capitalization rates, we don't have control over that. When we look at deals, it's important to know what the market is paying for that particular asset in that particular area. That's the cap rates. The value of the asset is now determined by the NOI and the cap rate, right? So it's a function of the cap rate and the NOI. The cap rate, we don't have control over. The NOI, we have control over. So the higher the cap rates, the lower the value of the asset. The lower the cap rate, the higher the value of the asset. So we try as much as possible to maintain the value of the assets that we operate. Another point is market knowledge. So market knowledge is important. And that's why even though I live in Pennsylvania now, I will hardly invest in Pennsylvania because I do not know the market. At Westworth Capital, most of our investments are in Texas. And that's because I lived in Texas for quite a while, and I know the market, and we have boots on the ground still in Texas, and we're well familiar. We have built relationship with property management companies, with brokers, with lenders, and Texas is just a growing market, and that's why we still maintain assets in Texas. So number 4 is ethical character. right? So ethical character is important, and that's because you trust us with your money, and that's a significant amount of money. And before you provide these funds, you want to confirm that I will act in your best interest, right? And so practically speaking, you want to do credit checks, criminal background checks. Also want to get referrals from the investors that this person has worked with in the past. And that's what I expect you to do if you are going to invest with Westworth Capital. Much has been made of this, and it's been reported that Donald Trump paid $750 in federal income taxes for certain years. However, the exact details and reasons behind this payment is complex and subject to ongoing debate. Factors such as losses carried forward, deductions, and various strategies can significantly actually improve an individual's tax return, and it can also impact your tax liability. So as real estate investors, it's important to understand that the tax code allows for various legitimate deductions and strategies that can reduce tax burdens for individuals and businesses. I was expecting to use the K1 depreciation loss, and this is coming from, well, one of our current investors. I was expecting to use the K1 depreciation loss on my taxes, and I can't currently because I am classified as a passive investor, and becoming a real estate professional is not something of interest currently. Can you explain to our audience why they can't take losses from their real estate investments against W-2 income, and what types of income are eligible for these deductions?
So basically, the beautiful thing about real estate is even if you're cash flow positive, the depreciation is going to offset that cash flow and create tax losses. Your income statement for your real estate activity will be negative. Because it has been so easy in the past and lots of wealthy people were using real estate to eliminate their taxes, they have decided to section off and create different classifications of income. So your real estate income is passive. And if you don't have real estate professional tax status, the losses generated from your K1s will not offset your W-2 income because those losses are in a separate bucket of passive income, which is separate from your active income, which includes your business income and your W-2 income. But there are exceptions to the rule. One is if you or your spouse has real estate professional tax status and you materially participate in either that rental activity where you're getting the K1 or in a collection of rental activities that could include that K1. There's another exception to the rule, which is if you were to have short-term rentals and the average length of stay was 7 days or less, and you materially participated, you could potentially create losses from real estate that you self-managed to offset your W-2 income without real estate professional tax status, but that is not mailbox money. If you're going to manage a short-term rental, that's a whole different asset class, that's a whole different type of activity, and you're going to have to earn your tax savings in that situation to manage it, at least in year one. Now, you can use losses to offset other stuff. So you can have other sources of passive income, passive interest in other businesses. Or if you do not materially participate in a business you own, and you own a business that's ran by someone else, you could potentially classify some of your income sources as passive and put it into that bucket that can be offset by the losses of your K1 from your real estate rental activity.
So as a follow-up to that, if I participated in a syndication, say about 3 years ago, and then there is an exit, and I initially invested 100,000, now I'm expected to receive 180,000, will profit from the sale qualify as passive income? And am I able to use the losses against the passive income?
Yeah, now it's good that you asked this question just afterwards, because when we tell people that these losses from your K1s can't offset your taxes out of your W-2, you might get a little bit upset and you're like, well, why are all these rich people investing in real estate and having all these advantages? It looks like I'm out of the game here. But actually, there's a lot of opportunities here, even if you don't have real estate professional tax status for short-term rentals. And even if it's not reducing your W-2, you still have cash flow that is offset by depreciation. And because these syndications are accelerating the depreciation with cost segregation studies, you're going to get more losses than you can use. So any losses that you get from these real estate investments, I want you guys to go in your prior year returns. If you have any of these, look for form, write this down, 8582. You're going to build up a reserve of losses from all your real estate activities. And that's going to carry forward to when you eventually have a capital gains event, and those losses will be activated. Anything that hasn't been used to offset other profitable, taxable passive income will be utilized when there's a capital gains event from your real estate, and it will offset that capital gains event. And that could also be if you are investing in other real estate. So if you have a loss from a different real estate property, that'll offset the capital gains on a separate real estate property. It's all gonna be used eventually. I like a lot of other things as well. I love real estate the most because it's reliable. I like it because you get to use leverage and other people's money to maximize cash flow and access to depreciation and tax deductions. There are incentives like the real estate professional tax status and 1031 exchanges that make this really favorable. But there are other asset classes I like oil and gas, where you can get the intangible drilling cost deduction. That's another way to offset income from your W-2, and you don't do anything at all and gives you passive income. So I like oil and gas. I like the idea of starting side hustles. We're working with clients to build solar panel companies to reduce their taxes, even if they're W-2s, and even equipment leasing companies. So there's lots of other cool stuff out there. But, real estate, I'm a fanatic of it. It's been, historically one of the best ways to build wealth, and the government has lots of tax incentives to encourage it.
So when it comes to passive real estate investments, would it be more effective to hold them in one's personal name or through an LLC? There's a follow-up to that, and it's what are the advantages and disadvantages of each option?
Right. So from a tax perspective, it really doesn't matter. The only thing the LLC will do is it'll provide some form of asset protection. But when you're a limited partner, you're not really subject to any liabilities. You're limited. So I really wouldn't be so concerned with asset protection. So the LLC, you can do it, and I've seen people recommend it. Whether or not you have an LLC will have no impact on your tax liabilities. So perhaps there's some asset protection opportunities with the LLC, but also you have to now pay to maintain that LLC an annual fee, depending on what state that's in.
I talk to a lot of physicians, and they're well familiar with the world of REITs. So the first question that they ask me is, how is this different from a REIT? What are the key distinctions and considerations that potential investors should be aware of? And for those in the audience who do not know what a REIT is, so a REIT is a real estate investment trust.
Yeah, so generally speaking, REITs are corporations. So now REITs, I'm not against REITs, and I've seen them, they can be profitable, just like investing in any corporation and having stock can be profitable. But some of the disadvantages with a corporation structure is you're not going to see the same advantages of depreciation flowing through onto your 1040 if you want to get passive losses. Usually when we have real estate and we're talking about taxes, we want to be able to flow through all those losses directly on our 1040, even without rep status, so the depreciation can offset other sources of capital gains. And we can build this reserve of depreciation to offset our future cash flow. If you're in this corporate structure, you're going to be paying taxes on your dividends. Your dividends are not going to be sheltered by depreciation. So there are reasons to investing in REITs, and then there are up REITs, which are really good for deferring cap gains. But generally speaking, if we're talking about an investment trust in a corporate structure, you're not going to see the advantage of paper losses.
So is it true that buying REITs is like buying stocks, right? Which is also subject to the volatility of any other stock. Yeah, so I think for me, the difference is investing in REITs and any other stock is the fact that they're actually backed by real assets.
Well, so another very big difference between like buying a REIT and investing in a syndication is the volatility, right, associated with a REIT or any other publicly traded equity, right? Like the public markets are very volatile, and on any given day, they move up or down, a percent, 2 or 3. If you're invested similarly, in a real estate syndication, this is a private investment, and the asset values of these private investments they tend to be much stickier, right? And because they're not publicly traded, and so they're not there are not like inflows and outflows on a daily basis that impact that impact like the value of that asset. And so, generally speaking, like the your investment stays uh, is more secure than if you have like, let's say $50,000 invested in a REIT, and there's like bad negative news pertaining to that REIT on any particular day. Like you can watch your investment drop 10% potentially, depending on like the quarterly returns.
I mean, well, I would say for most people, it makes more sense to invest in real estate than start a restaurant. But if your heart's in starting a restaurant, start a restaurant and put your savings into real estate. But the thing that's beautiful about real estate is, now take this with a grain of salt. I'm a real estate CPA who works with real estate investors, but when there's just so many ways to have tax-free income and to reinvest into more and more real estate and compound your wealth. It just opens up a whole world of opportunities that you're not going to see in other industries.
Let's take it back to this cost segregation, depreciation. Can you explain the context of cost segregation for real estate investment? How is it done? Can anybody do it? Say that I want to do a cost segregation study on my property. Can I do that, or do I need an expert to do that for me? Also, what types of assets do you advise that you can perform the study on? Can you do it on single family homes? I own a single family home with my family. Can I do the cost segregation study and take the tax write-off from that?
So the way the cost segregation study works, now I'm going to start at the base level. When you have real estate, one of your deductions is depreciation, which is to account for the wear and tear of an asset over time, based on the assumption it's going to be losing value. And real estate depreciates over 27.5 or 39 years, which is a long time to write off that purchase of the real estate. When we do a cost segregation study, we evaluate this real estate and we find different items in the real estate that will depreciate faster and give you faster deductions to create tax losses. We may find those deductions to be cabinetry, ceilings, fans, window curtains, driveways, carpet, refrigerators. These are all things that will be useless and will wear out faster than the main structural components of the real estate. And this gives us massive deductions. Then there's something called bonus depreciation that allows us, once we've assigned a value to these items and we can write them off, we can write off 80% of any of those items identified in this cost segregation study that finds these items that depreciate faster within the real estate and breaks them out. Now, to do this, it takes a good amount of effort and expertise. The way that it's done is they will use a job costing software, and that software is used it's called the RS Means database, and it is used to assign and quote for different construction projects and assess the cost of the labor and the materials. And based on the features that you've evaluated and the specs of the property and square footage, you will run it through an algorithm, enter different information, and you will determine the fair market value of each of these items, whether it be the structure, the driveway, the balcony, the deck, the patio, the pool, et cetera, et cetera. And that allows you to identify what you can depreciate faster. This is, we have an in-house cost segregation engineer. It takes a long time for him to be independent in doing this. And this is not something you would DIY. Not only that, but you may not even know if it makes sense. So you got to work with your tax advisor before investing in an engineer to do a cost segregation study, because anyone will sell you a cost seg study that offers it, but you need a tax advisor who understands the concept to make sure that it'll actually reduce your taxes. And yes, we have done cost segs on single family homes that are rentals. What we just want to make sure is that whatever it costs to do the cost segregation study, we can create significant tax savings to justify that investment.
Let us talk about the tax liability at the point of sale, right? Definitely some tax, and you may have answered this earlier. Just want to be clear for the benefit of the audience. So at the point of sale, what are the other strategies that can be done in order to, because I've heard people throw around 1031 exchange, for example. So what are the strategies that you will typically recommend to your clients when they are selling the property and they're trying to avoid taxes?
Yeah, so we have a lot of things that we can do. Now, the most common ones you'll hear, and which we do often, are 1031 exchanges. That's where you identify a property to replace the one that you're selling. It has to be of equal or greater value, and it just has to be any form of real estate. So you can exchange a single family for a multifamily for a farm or a hotel. It just has to be real estate. And so when we've done that oftentimes, and that'll defer the capital gains indefinitely. A lot of times we have a 1031 that fails, or they can't find a replacement, or maybe they do have a replacement, but it wasn't done through a 1031. In that case, we just do a cost segregation study on another property, or maybe we invest in a syndication such as your own, and they run a cost seg, and those passive losses can offset the capital gains as well. Some other things that we consider are qualified opportunity zones that'll defer the gain. And another thing that we do that's a little bit, some other ideas are taking your proceeds and just redeploying it back in your business if you own other businesses. And then those deductions will offset the capital gains. And then finally, we'll even consider investing in oil and gas, where you write off up to 90 cents per dollar of your cash investment. And that'll reduce your income being taxed at your ordinary rate, which will overall reduce your taxes and any additional tax that could have been generated from your capital gains. Got a couple of other things we do, but those are the ones that we're most likely to discuss. Now, also, a lot of times we get clients who are selling properties for capital gain, but we'll oftentimes realize that there's either no or minimal taxes because they have losses from their other properties that have been accumulating over the years.
When we are evaluating the property and we want to research the area, there are different tools that we use. Number one is bls.gov. We want to be sure that we know the employment trends in that area. We want to be sure that we know that jobs are growing, know that employers are moving into that area. So we use bls.gov a lot. Another tool that we use is bestneighborhoods.gov. In fact, as a matter of criteria, we will not invest in any area that once we put the address on bestneighborhoods.gov and then we zoom in on the particular points on the map, and if it is red or deep orange, we know that that area we will not invest in because that's like a low D-class neighborhood. So bestneighborhoods.org is a really great tool that we use. We also use world population reviews and also the population census.gov, quick facts. And census want to know over the past 10 years, as the population in this particular area increased or decreased. Is it increasing or is it decreasing? And the areas that we invest in, we see that the population growth is always positive. And also business expansion news. So we subscribe to business expansion news. That's where we get news of businesses that are moving into a particular area, because that's another way of getting into a particular area for cheap. So let's say that the news is not out there yet that Amazon or Tesla is moving to Harrisburg, for example. We watch the business expansion news. We see how many jobs is this new company going to create. This is an area that is in the path of growth and what have you. So that's how we do research in the areas. And also the average cap rates. So you're looking for an area that the average cap rate is between 6%, from 4% to 6%. If you go lower, you're toying with cash flow, with investors' cash flow. Those are high value areas that you will not necessarily make a return on your investment if you invest in, such as California. Of course, California is a blue state. We wouldn't even touch California with a 10-foot pole at this point. But California is an example of San Francisco, right? Really low cap rates, 2%, 1%. You don't want to invest in that because you actually want a return for your money. At the same time, you don't want to go investing in a war zone. You don't want to go invest in Southside Chicago. And that's why they are high cap rates, right? They make returns, the rent and everything. The returns is a lot, but it's riskier. So we like to be in the middle. We like to be in the average areas that we know that we can get good return on our investment. Essentially, we're looking at primary and secondary markets. So we just like the market because it's a growth market. We like to invest in the red states. for obvious reasons, right? They are business friendly, they are landlord friendly, and that's why we continue to. So how do we underwrite our deals? First of all, we want to know the average cap rates in the area. And what are we getting? We pull the CoStar report. So we subscribe to CoStar. CoStar is the largest data aggregation company in the world. So when we pull the CoStar report, we want to know the properties that have traded recently, how much did they sell for? What's the average cap rates after those sales? Once we get that, and then we get the guidance, the pricing guidance, and we put them in our model. So we have a model. We have different types of models that we use. We have the ones that we can actually do more or less like a back of the envelope underwriting. Now, when we drill down to a property that we actually want to expand underwriting on, and then that's when we actually use the main model. We enter the purchase price, we enter the debt. At that point, we would have received quotes from lenders based on the current interest rates. However, you always want to go about 200 basis points above you use as interest rates when you're underwriting the debt, because between now that you've just been quoted with a 6.5 interest rate, by the time you close or by the time you lock in the interest rates, keep in mind, we are raising equity. So there has to be the evidence. There has to be the proof of funds, which is after we complete or get to a certain level in our equity raise, then we go back to the lender and be like, hey, we have this money in our account. Can we lock the interest rate? So all numbers are still wavy up until that point. So we like to generally underwrite with about 200 basis point above the current quoted interest rates. So when we get that, so another point that we look at is we run a 10-year model. We know that we're holding the asset for 5 years, but we try to run a 10-year model. And if the cap rates, if the ongoing cap rate is, say, 4.75, we will underwrite at a lower valuation. That is where we underwrite at, say, 5.5. We are also underwriting conservatively for exits because we do not know what cap rates will do in the future. So what we are doing at that point is saying after 5 years, you cannot guarantee that this area will continue to grow. Of course, it's just basic common sense, right? So the current cap rate is 4.75. You know that year over year, cap rates have either remained stable or they've expanded or constricted, whatever the pattern is. And then you want to, what we do is we generally now conservatively say, okay, it's 4.75 today. Why don't we just leave it at 4.75 for 5 years to come, right? It's a growing market. Technically, it should actually reduce, right? Because the value would have appreciated, and also you're getting rent increase, which will increase the net operating income, which ultimately will increase the value of the asset. But you want to keep things as is at this point. So that's one of the ways that we conservatively underwrite. We do not project too much growth. And we know that obviously on underwriting conservatively, you're not going to go wrong. I think another point that we tend to look at when we are underwriting is, are there any value add opportunities? Because that's really important. If we are buying a Class C asset, is there anything we can do to increase the value? If we see something, you say, oh, we're touring the property and we see that it's got a large premise, the premises is so large, maybe we can actually do covered parking and have people pay $100 a month or $70 a month for it. So that is adding value because that is going to go into the gross rental income. Remember when I said earlier, the only thing that matters in this world, in real estate, multifamily, is the income. Nothing else matters. Unlike single family homes, your 1 unit to your 4 units. How much did my neighbor's house sell for? That's how much my house is worth. But we are able to do forced appreciation for properties in the multifamily sector. It doesn't matter what the next 10 unit building sells for. The 10 unit apartment next door might have sold for $1 million. My own 10 unit building, I can sell it for 15 by forced appreciation because A tenant is going to come here, is going to see the granite countertop, is going to see the aluminum appliances, and is going to go there and is going to see the carpet and is going to see the white outdated appliances. A tenant is willing to pay $150 more for my apartment to stay rather than that one down the road, right? So, and of course, it then affects the property value, and then my property value goes on. That means I have forced the appreciation. What other things are we looking for? Can we start charging for internet? So another thing is the internet, right? The internet surcharge. So we go into contract with, say, Xfinity or with AT&T, and then the wholesale internet for us. Let's say the market internet rate is $50 a unit. AT&T comes to us, or we go to AT&T. Hey, we have 300 units apartment community that we want to implement internet. Are you going to give us at $40 a unit, or you don't have our business? AT&T will be like, yeah, we'll do it. So AT&T gives us at $40. We are not cheating the tenants because they're still paying $50. But we are increasing our NOI because we're paying AT&T $40 per unit. So those are some of the things: paid parking, reserve parking, dog park. So that's how we underwrite. We want to make sure that value add opportunity is there. And one thing I've noticed is a lot of investors, they can be emotionally attached to the property, which can be a good thing and it can also be a bad thing. So I try to educate investors that don't be too emotionally attached to the property. And when I say emotionally attached, they want to be on the golf course and be like, hey, I invested in that property. That's good. That is a good thing. But how much is the property making you? That is the more important question. And you will see that some of these properties that we're talking about, the Class B, the Class C assets, they're actually cash cow, even though they are not as pretty as the Class A assets. Class A assets are stable, and that's why the institutional investors invest in it, because they want their money where it is. Wealth preservation. We also invest in Class A properties, but before we invest in Class A properties, we want to be sure that at least the investor is getting a reasonable amount of return, at least 6%. If comes to me and asks me what's the state of she's an investor in one of our deals, what's the state of this property, I am able to give a first-hand information. I'm not going to tell her like, hey, would you give me till tomorrow morning for me to get back to you? Because I know everything that's going on. I know everything that's going on with the property because we keep the assets management in-house. Some people outsource it, which, by the way, eats into the profit as well, right? So we get on the phone call with the property management company. We review every little detail of the property, including lease, upcoming leases and upcoming lease trade outs and contracts. And we actually, and talking about actually reviewing everything, we have in writing with our property management companies that they are not to spend any money that is over $3,000 without our consent. So we have to have our approval before they make any repairs that is over $3,000. So the risk management piece, you don't have to worry about that. Now, the market knowledge, which I mentioned earlier, is that we have boots on the ground in everywhere we invest. And at any point in time for any of our properties, there's someone that can get there within 5 minutes. No need to book a plane ticket, and we are always there. So we know the area, right? And we perform in-depth research into the market. Even new markets, we try to take a while before we start to get into new areas. And of course, our criteria are really clear. Areas of positive migration, areas that favor businesses. I'm not going to invest in New York. It takes 1 year, excuse my language, 2 years to do eviction, right? That's not going to happen. In Dallas, you don't pay my rent, you're out by the next month. 3 months tops, right? So that's why we invest in Texas. And so what are the steps in investing in and owning your own multifamily real estate and being part of a syndication? It's pretty straightforward. It's really, really straightforward. First, we start with a phone call. It's a discovery phone call. And you meet with Westworth and the co-sponsors, and we do a little introduction. And then we schedule a Zoom meeting where we actually deep dive into our deal. And then in person, we also, if you're nearby, we prefer to meet over coffee right? And continue to chat and develop a rapport. Then we present you the investment opportunity. You review a current opportunity. You join the investor webinar to learn more, and you place a non-binding soft commitment, right? So when you register at our portal, you are not, even though you say, "Hey, I'm going to invest $100,000," it's non-binding. You can change your mind tomorrow, as long as you have not actually signed the private placement memorandum, which is the fourth. Then you review the PPM, and then sign the subscription documents, and then you wire the funds after, and then sit back and enjoy the returns on your investment. Do something.